I do believe we are able, together with RedStone and Credora, find a model where we don't have to downgrade our standards in order to please anyone, rather keep a very high stance and follow, as you guys mentioned, L2B model, where initially people might even not necessarily like us, but the general public is going to recognize at one point that we are needed. With such situations as stream finance blow up, where people thought that allocating into strategy that gives you double-digit yield without verifying is okay, when it turns out it's not, with almost $100 million hole in it. Credora at that time was not live yet, but we did some backtesting, and we should have given it a C rating, which is very low for the standards in DeFi at large.
Nothing said on the Edge podcast is a recommendation to buy or sell tokens or securities. This content is for educational and entertainment purposes only. Nothing shared here is financial advice.
Welcome to the Edge podcast. I'm DeFi Dad here with Nomadic. Today's show features Gil Santos, Lead Quant for Credora, and Marcin Kazmierczak, co-founder of RedStone. Guys, thanks for joining us. How are you doing?
Hey guys, thank you for having us.
We've had Marcin on the podcast a few times. I don't know, probably 3 or 4 times now, I'd say. But Gil, this is your first time on the pod. So why don't we start with a bit about your background? What did you do before Credora? What originally pulled you into this space?
Absolutely. Yeah. So I think the story really starts around 7 years ago. I was working at a fintech company. And at the time, we were raising capital for doing lending in general. So you can think about it as like the company that originates auto loans, but instead of auto, we're talking about lending equipment. And at the time, we were raising capital with Goldman Sachs and other investment banks. And long story short, the company got squeezed by these banks and had to eventually shut down due to liquidity pressure. It's the classic like David versus Goliath story. And it just stuck with me a little bit. And from there, I moved to banking and tried to see the other side of the equation. And really realized that's just, it's not magic, right? So I saw the inefficiencies, I saw the gatekeeping and how they control who gets information and what, and just realized it's just a bit unfair overall. It felt a little bit like being inside the Big Short movie. So that's where DeFi came into play, right? So DeFi comes and adds all these layers of that we all love, right? The transparency, the permissionless liquidity, all these things that are great in theory, but then the risk just gets so packed, and we add so many layers, and we make our job so harder. Then it's just we're back at square one. So that's where the opportunity for analyzing risk came from, and that's why Credora made sense for me.
RedStone acquired Credora. Can you talk to us about the relationship between Credora and RedStone, and why did you acquire Credora?
Of course, happy to. So good to be back. Backstory of Credora acquisition. So around May and June of last year, we were thinking, what can we bring more to our clients that are asset issuers, decentralized applications, and chains. So those are the 3 major ones. And the 4th category is institutions. And usually when we try to do that kind of a brainstorm in RedStone, we think about concepts that work very well in TradFi, are adopted, proven, and bring a lot of value for the wider participants, and how we can essentially replicate that on-chain. And we've seen it over and over with DEXs, lending, with options, for example. It didn't work out at least yet that much at scale because we have perpetual exchanges, but ratings was one of them. And we asked ourselves why. And reason for ratings not to pick up that much in DeFi, there were 2 major ones. The first one, you need a lot of data to produce good ratings. So as long as you have good data and a good engine, then you can produce high value ratings, and we did have it. And the second one is distribution. And around similar time, Darshan, one of the co-founders of Credora, reached out to us asking to package the offering of Oracle and their risk ratings. And I said, yes, that makes natural sense. And over time, that relationship deepened, and Darshan learned that working with our team is what he said. Those are his words, a pleasure, and we are very reliable with high integrity. And when they learned that it's not so easy to monetize and create sustainable business models solo in that business, it naturally made more sense to join a team where they feel comfortable and confident that can execute on their vision. So we are glad that after the acquisition last year, both Darshan and Moody, two co-founders, joined us as strategic advisors. So they are hands-on, week-to-week involved in continuing building on that vision. And also the absolute stars of the previous team also joined us. For example, Gil, that is together with me today.
Guys, what is the problem that DeFi is struggling with when it comes to risk and trust? I'd love it if one of you could just even dumb down what is risk? Like, how do you define risk in DeFi or TradFi? In DeFi, yield shouldn't come from chasing dashboards or timing markets. KPK runs non-custodial vaults and on-chain funds built for stable, risk-adjusted returns. Capital is allocated across curated strategies and managed by automated agents that act within seconds under predefined controls. No custody, no manual intervention, just disciplined execution on-chain. If you're allocating capital and want sustainable yield with stronger controls, visit kpk.io. Ever since the basis trade, DeFi has searched for yield that actually scales, until now. Main Street brings the options box spread to DeFi, a proven delta-neutral strategy. Paired with Accountable's real-time proof of reserves, MSY captures a multi-billion-dollar source of TradFi yield and redirects it on-chain. Institutional yield now built for everyone. To learn more, go to mainstreet.finance. Accountable is the new standard for real-time financial verification. In crypto, financial health still runs on screenshots, lagging audits, and blind trust. But Accountable changes that. Powered by the Data Verification Network, it proves assets and liabilities privately across wallets, exchanges, custodians, and banks. Accountable already secures over $2 billion in verified assets across 115 chains and over 90 data sources. To learn more, go to accountable.capital. In DeFi, most stablecoins ask you to trust them. Trust the collateral, trust the peg, trust the managed risk, but Noon proves it. The stablecoin built for the highest yields, highest returns, long-term. With transparent reserves, real assets, and delta-neutral strategies, access real yields in real time. To learn more, visit app.noon.capital/vaults. Neutral is the next generation of crypto-native yield. Their synthetic dollar NUSD taps into OTC arbitrage, funding rate inefficiencies, and delta-neutral strategies to deliver premium, stable returns without taking market direction risk. Neutral is now officially live to mint NUSD and start earning neutral points. Learn more at neutral.fi.
Usually risk is seen as an independent team within bank, and they're responsible for really just answering a question, which is how likely it is that this goes bad, right? And they are seen as independent because they don't want to be, let's say, in bed with the people that originate the loans, the sales team, the business guy, because you want to have this independent structure that keeps opinions around the credit worthiness of that. So you can think about it as a team of nerds, really, that are just trying to quantify things and try to get to the bottom of the likelihood of such deal ending up in a bad scenario for either the bank or the DeFi protocol or whatever the entity that we're talking about here.
And let's kind of stay high level here for a bit, because when it comes to ratings, I mean, there's a few that I've heard of. You know, I'm not a TradFi guy, but I've heard of Moody's. I've heard of S&P. Maybe let's talk a bit more about what those kind of big institutions do in the real world, and then we can kind of get to how Credora mirrors this in DeFi, or maybe your approach is totally different. But yeah, walk us through just the Moody's and the S&Ps of the world, and and sort of the role that they play in traditional finance?
Yeah, so maybe first I will add to what Gil said, that in my view also in DeFi, the core problem is that information asymmetry is disguised as transparency. And let me explain what I mean over here. So in DeFi, you have transparency of transactions, but opacity of risk. You can see every transaction on chain on any explorer, but you can't compare whether a Morpho USDC vault is genuinely safer than, for example, Aave market. What you see is only the APY, which, by the way, is annual percentage yield, and hardly anyone keeps anymore their allocation in one strategy for a year itself. So many of the times you think 6% over the year, but you allocate money only for, let's call it 90 or 80 days. Most users don't understand the smart contracts and protocol mechanism in general. So right now, there is no screening mechanism. As Nomadic said, in traditional finance, they have credit scores. But right now, DeFi purely relies on over-collateralization in lending markets, meaning liquidation cascades hit equally hard, whether you're a sophisticated institution or retail users. And in DeFi in general, you have those periods of hardcore investing that we've seen before 10th of October 2025. Like there was a lot of leverage that was essentially deleveraged very effectively on one day and then the blow up. And DeFi is only so much more complex than we saw it in 2020 or 2022 even. Initially, we had USDT, USDC as stablecoins, then Etina, Ondo. Now there's over 200 types of them. And tokenization is also getting more and more sophisticated. Now, going to the traditional finance rating agencies, we should look at the history in general, and I will then pass to Gil about the value proposition. So first, ratings started to emerge at around 18th century, at the end of the 18th century. But you know what? No one cared about them initially. So there were those rating agencies, but no one necessarily looked into them seriously. There was this critical inflection point that not many people know about. That was in 1936, when the office of the comptroller of the currency mandated the banks that could only invest in securities rated as investment grade by recognized rating agencies as S&P and Moody's, as Nomadic mentioned. Here, an important distinction between controllers and comptrollers that I learned recently is that the first one is looking at profit organizations and doing accounting functions, whereas the second one, comptroller, is working for governments and non-profits. Now, what is an investment grade in TradFi? Because it's a very known concept. So investment grade, or IG in short, is a bond or a product that has a high credit quality debt rated with BB minus or BAA3 or higher, and is offering lower risk and lower stable yield, which is ideal for capital preservation. And this is what banks could invest into after that change was introduced. Whereas anything that is below this BBB minus threshold is considered high yield, which sometimes are referred to as junk bonds as well. And I strongly believe that in DeFi and crypto, we have this inflection point ahead of us. So something that is going to make people realize that this risk rating, like some simple metric, will define what people should engage with at large and institutions at large, and which ones should be considered rather higher risk and not necessarily investable at large. And here I will pass to Gil as well.
Yeah, exactly. And I think the really interesting thing about risk ratings is that they're popular because they are this universal language of risk. So everybody can compare and can use the same scale, assuming they are within the risk business, of course. And it just allows for someone, for example, someone from Europe to invest in a copper mining company in the US and have zero knowledge about how the copper industry works. But based on the rating, they can make a judgment call and they can decide on whether or not to invest. And this is super powerful because it just solves the scaling problem. You have more capital available because of ratings. And this is the vision that we believe that for DeFi makes sense, because for us, as we currently have a ton of options in DeFi, we don't have a unified way to measure risks, that is the rating.
Before we talk more about the opportunities for improvement with legacy ratings agencies and what you're building with Credora, can you give us the elevator pitch for what is Credora trying to be for DeFi?
Sure, happy to. So Credora is becoming the comprehensive risk rating standard for DeFi that on one hand enables users to take more informative investment decisions, and on the other, institutional capital to flow at scale by making risk legible in real time. What it means is that Credora is building a dynamic and quantitative risk rating system that updates in real time, so both manual, so people, and automated, for example, AI, capital allocators can make their decisions well to allocate money and which investment opportunity to take part into. And what is important is that it's not a theory. Credora already has over $9 billion of on-chain capital in vaults and over $500 billion of total market cap of assets rated. So it is already adopted at scale, present on both Morpho and Spark, and soon on many other DeFi protocols.
Could one of you talk to us about how do these Credora ratings work at a high level? Like, I know they're useful when I look at like an A/B rating on some protocol. It speaks some meaning to me, but I've never fully understood what do you do in order to generate that rating.
Yeah, I'm happy to help you there. So the ratings that we do, they are sequential in a way, right? So if we think about a vault, the exposure that you have on that specific vault is going to be, and the risk that you have in that vault is going to be dependent on the exposures that you have underneath, right? So in a Morpho vault, for example, you will have different lending markets that the vault can allocate to. And those markets then have also exposures to collateral assets, right? Because the collateral asset itself is a liability and can default on its own and lose the value. So what we do here in our ratings is really a combination of quantitative models that are used for assessing the risks in lending, and also more traditional type of methodologies where we assess the risks by looking at different factors within a certain token. So the sequential effect goes from assessing the collateral itself under each particular lending market or lending protocol, assessing the risks of the lending its activity itself, and combining everything then in the vault section. So what you're seeing here is a framework that is very modular, because a vault can be a combination of multiple things, right? So you can have vaults that can combine different strategies, and what we try to do is divide those strategies, assess the risk of them individually, and then group them together into a vault level assessment. And the beauty about it is that we translate everything into a simplified scale, as we were saying before, where we can basically bring a number and bring letter that is interpretable for the user, right? So all this backend work that happens on our side is all culminated into one probability, that is our assessment of probability of having a significant loss, and into a rating that is a letter rating from A+ to D. We have done the work of mapping this to traditional scale, and I think this is the value added of Credora, is really being able to quantitatively measure risk and not only provide a score that is just based on opinions.
An important part of it here is also that in traditional rating, you can see that A+ consists of plenty of letters from TradFi, even to BB, B+, whereas in crypto, things are way younger. And the most important in that phase of development of the market is to properly distinguish junk, like really bad strategies that are fundamentally flawed, from the ones that are either super safe or still experiment with sound fundamentals. So here, that's how it translates also in the scale itself. Talking about where we stand right now, as of January 2026, we have over $10 billion rated across all the strategies, with 67 vaults already being rated. That covers over 80% of Morpho TVL. We have north of 60 assets already, actually, with 235 markets and 100% coverage of the Spark TVL. In practice, if you go today to Morpho app into the Earn section, you can choose a vault, for example, Stakehouse USDC, that is known for being extremely conservative and safe, low-risk DeFi kind of like yield. You can see in the risk section that the rating by Credora is assigned, and you can check out the documentation how it is being derived from. However, simple letter doesn't tell you the whole picture, the whole story, just makes it easy for you to take a decision. In Spark and also in Morpho right now, we are working on bringing some more information to the front end, to the user. So it's not only about the rating itself, but also the probability of significant loss in terms of percentage, and a detailed profile that includes a couple of verticals and a card that makes it visually appealing for a user to decide whether that asset or strategy is adjusted for a particular allocation appetite.
Can you talk to us about an example like the Stakehouse USDC? It looked like it had a higher rating, like an A rating. When you talk about minimum, maximum probability of significant loss, can you try to just dumb that down a bit further for us? Because we know in DeFi that if there's some sort of smart contract bug, you can lose everything, within seconds. But we are getting to a place now where certain protocols like Morpho, Aave, Spark, I think as they become more battle tested, the longer they, survive without an exploit, we're seeing that probability shrink. But this is just something that seems really difficult to translate. Like, what in TradFi could you lose within seconds versus what we know we can lose to some unforeseen exploit in DeFi? So I think my question is, for Stakehouse USDC, this rating that I think is an A, can you try to just dumb down a bit of like how you arrive at an A? And then I want to talk about the opposite example. I want to talk about, what's an example of a rating? What's an example of a yield that has been rated much lower, than something like Stakehouse? MNT is now live on Solana, powered by Mantle Super Portal, where real-world finance and internet capital markets flow. Access Solana native DeFi with MNT by trading, swapping, providing liquidity, and more to maximize your yield. You can now teleport MNT between Solana and Ethereum instantly, securely, and seamlessly at superportal.mantle.xyz. Puffer is building the ultimate vertical in crypto. Your crypto deserves better yields. Better yields require better infrastructure, and Puffer is building it. Puffer Liquid Staking delivers above-market ETH yields, secured with up to $5 billion in slashing penalty protection and buffer. Puffer Institutional offers compliant, secure, above-market ETH yields for DATs, institutions, and large players. Puffer Unify is the first synchronously composable rollup, enabling the next generation of app chains on Ethereum with sub-10 millisecond transactions. Unify AVS enables pre-confirmations, making Ethereum validators more profitable and rollups more scalable. Puffer is premier infrastructure and yield for digital assets. Stake your ETH at app.puffer.fi.
if we want to assess the risk of default, in this case of Stakehouse, this vault is a very safe vault because of the market that are allocated to inside the vault. You will see markets that have collateral assets that are rated B plus and above. So the likelihood of the collateral itself depegging or losing value is low. And then we look at the setup of the market itself. So how were they set up in Morpho? So the Oracle, was it set up properly? Is it a marketplace or a fundamental Oracle? How does the liquidity in all DeFi looks like for that particular loan collateral pair, so that we can answer the question of how is it going to perform under a very stress market event, and how are the liquidations going to be executed. Because our goal in the end, as you said, is to calculate the probability of a significant loss. And a significant loss for us is defined as a loss above 1% of the capital that you have within that vault. So to have a loss of above 1%, if you think about the whole lending, that means that you had to have a certain market event that was so abrupt and so disruptive that no one liquidated, and that led to eventually bad debt. So the good result in certain vaults versus the bad result in other vaults comes from the setups of the markets and in what we've seen as the bigger drivers of risk within these markets have been, for example, poor Oracle setups, collaterals that allegedly have a good backing, but when you do the due diligence, you realize that they don't have that much transparency around them, and there's some shadiness around them, and this problem then propagates to the lending markets and to defaults and just creates a riskier setup.
Guys, one thing I want to ask about is just thinking about ratings agencies. One touch point that I've had in my life is, The Big Short, one of my favorite movies. But you look at ratings agencies kind of propping up garbage, mortgage-backed securities, giving them AAA ratings, basically not doing their job and assessing risk properly. So I'm always kind of skeptical about ratings agencies naturally from that. And I guess part of what I want to know is what is the incentive model behind this? Maybe I don't even know how Moody's makes money, but I'm assuming they get paid for ratings. How does this work with Credora, and how do you kind of maintain that credibility, but also being able to monetize your product, if that makes sense?
Excellent question, Malik. And I can also bring my favorite scene from that movie when Ryan Gosling is asking the other guys in the room whether they can smell it. Your cologne? No, opportunity, right? And over here, we see the opportunity to properly bring a new standard for ratings into DeFi, taking what's good from TradFi, but also trying to innovate on aspects that they are not following the best. Speaking about monetization, we charge protocols for having them rated. So we're asking the protocols to cover the cost of being rated, and also asset issuers, if they want, they can request a rating to get covered. The incentive structure here in theory is very similar to TradFi, but in practice, our ratings are transparent in the sense of methodology. Everyone can go to docs.redstone.finance and go into the Credora page and understand how the rating is derived. As Gil mentioned before, it's broken down into a probability of significant loss and percentage, and then categorized into specific rating. And anyone that is going to get a rating can request some guidance on what caused a rating to go down, especially. If someone's getting a C, we can explain what are the causation for that particular part. I think it's also important to understand that with Credora, there is a bigger picture than only charging the protocols, because the rating is a product that can be integrated into multiple other products, such as, for example, insurance, in order to define what is going to be a premium on an insurance of a particular strategy or allocation. The higher the rating, the premium could be smaller, and we are already in discussion with some insurance protocols to utilize Credora ratings for that particular use case. And the other one are AI agents. Hardly anyone believes that over a long period, people will be trading. Already we can see it on the markets that bots are trading, and more AI is going to be utilized over there. And there is a big fundamental problem with AI getting hands into allocating capital, which is called hallucination. And in things such as allocating capital, the results can be disastrous because one simple mistake can cause a loss of almost majority of the funds that AI is allocating. So here, I can imagine in a short future that AI agents will be bound to allocate only into protocols that have the rating present. And it doesn't even mean that they cannot invest into something that is rated C. No, like it should be a conscious choice of choosing a lower rated product with higher yield. But the worst choice that an AI or even individual can make is choosing, for example, high yield or even lower yield with high risk, because apparently sometimes there are those strategies that are fairly low yield compared to the risk that they are presenting at large. But answering your question more directly, we've acquired Credora only a couple months ago, and we are still also trying to figure out how to best adjust it to the crypto rails. There is more data and transparency that we can use for our engine, and we want to be also creative with monetization long-term so that there is no fundamental problem with a conflict of interest.
We've got a number of questions here that I think we're asking as users that would be looking at those ratings. So this is kind of like a rapid fire style of answering. So first, are curators opting in for this? Like I imagine that they play a significant role in terms of the adoption of Credora.
So similarly to TradFi ratings, an entity can request a rating, but is not bound to showcase that on the website. So in traditional ratings, it works very similarly, that you request, you get a C, then you can ask, like, what is the reason to work on upgrading it? Or even better so, there are strategies of showcasing, for example, let's call it B-, and showing that you're improving that rating over time by implementing changes so that you can showcase the positive trend towards the risk assessment of your strategy, keeping the yield relatively high.
Marcin, quickly, just even before that, just how does somebody get a rating up? Like they have to opt in, right? Like the Morpho Vault curator has to be like, hey, I want this, right? It's not given to them automatically. Is that correct?
So Morpho specifically requested us as Credora to be the first platform for their protocol to give the ratings. So we have a contract with Morpho that we proactively rate more and more vaults based on what they are asking for. And we suggest to the vault curators that they should ask for the rating itself and get it displayed. So it's a bit of a play where Morpho is an unopinionated platform with those vault curators, but naturally they want to give more and more information to the users, so they are incentivized to encourage the operators to ask for the ratings themselves. However, if we give bad rating, they cannot force a vault operator to have it displayed on the website itself. Though we have no constraint of showing that lower rating on our Credora platform that is going to come online fairly soon. Neither we are constrained to give that lower rating with our API that is, again, going to be used by many other protocols out there. And it's going to be a very known concept for anyone who went to school that is called peer pressure. As long as the community is going to give enough peer pressure on the vault operators and asking, hey, why is it not rated? It can become like a proper standard. And I strongly believe this is where we have to go to. I am fine answering question why this is rated B- or C, not an A, but I am not fine answering a question, hey guys, like why is it not displayed over there? No, like we want to rate them, and then we can go into constructive discussion, like what should be the improvement to the methodology, because this is important. We keep improving the methodology. We are open to feedback. We've already had very vivid discussions with Gauntlet, Stakehouse, so people who are experts in that field, and we've updated it based on some of the valid feedback that is in general applicable for the methodology and the engine itself.
Yeah, I'm glad you brought that up, because that was one of my other questions. I know right when you guys launched these, everybody had an A rating, and I saw some criticisms like, oh, well, like everybody's getting an A. Well, no, not everybody's getting an A. People that opted in to show their risk score got A's. And this idea of peer pressure, I think, is actually really needed and really important to this whole equation, because hopefully what's happening now behind the scenes is all these people that haven't wanted to expose their rating, maybe they got a B, maybe they got a C, maybe it was A- and it wasn't an A, who knows? But it's going to make them work behind the scenes to get on the program. And what do they have to do? They have to, hopefully make better risk decisions under the hood on whatever their strategy is to, get up to snuff and be competitive, because you're actually creating, this new sort of grade for, you're raising the bar essentially for where you have to be. And I think that's really important. So how much of this is automated? Because vault strategies can change on the fly. People can tweak how they do things, and how does the Credora system catch that? And I guess ultimately I'm sort of asking, like, how much of this is human in the loop doing stuff and monitoring things, and how much is, again, automated on your end to catch these changes and sort of update ratings on the fly?
Yeah, so it's a good question, because that's exactly where we see our most added value when you compare with traditional finance. Our ratings are dynamic, right? So the objective of our ratings is not to have them updated on our annual risk committee. We want our ratings to be very dynamic and respond to market movements. So we have these ratings being updated from and being produced automatically from data that we collect from multiple sources. We're talking about price data, liquidity data, any market data that is relevant for the assessment of each particular vault and market. And all these plug into this final rating that is composed of some more fundamental static factors, such as like the structure of the market that doesn't change once at least in Morpho, and then dynamic aspects that can change over time and that we want to capture. So we make sure that the ratings are refreshed on a very high cadency to reflect the current conditions.
Guys, can we talk through an example of how Credora changes how risk is understood with rating, all of these on-chain primitives, derivatives on-chain. We've got RWA-backed stable coins. We have vaulted liquid strategies for like stable coins. We have tokenized commodities now, like gold. How does Credora, I guess, like change our understanding of risk? Like, where's the improvement, the 1000x improvement maybe that you see here through Credora?
Yeah, that is a very deep question. And it goes really well with what we're working on right now, because we are surprised every day, to be honest, by the results of the data analysis that we do. One more personal take that I have, but I'm really bullish on the lending markets and lending technology, because the more simulations we do and the more work we do around it, we see that it's very resilient. So I can see a world where lending together with stable coins make up new types of financial products that can be used in real world, right? So I think this is the things that over time we start grasping and we start understanding where the real use is. For example, for markets, we start realizing that, these oracles, that they are very different and they bring very different behaviors to markets. People don't realize this, but if you have a market-based oracle, you have a dynamic price. If you have a fundamental oracle, you have a price that is fundamentally decided. So if there is a certain move in the market, it's not going to capture. Which one is better? Depends on the context and depends on the asset itself. So it's a very broad discussions, but it's those discussions that we start having internally and with our partners, and it's just it's starting to raise the bar. I think that's the biggest impact that we've seen. And on the asset side as well, like if you think about derivative assets, not all of them have the same type of quality, and we see that the governance around them impacts a lot. So the smooth functioning of these instruments is also very dependent on the asset itself. And you start seeing patterns. You start seeing things that are common across assets that are lower quality and across assets that are better quality. And ultimately, because our space is very new, what we want to continue is to continue to grow our database around metrics that influence better decisions.
One thing I've thought a lot about, because I want to see Credora be successful, I want to see that standard in the industry to offer these transparent ratings for different yields so that you can better understand what are you putting your money into. And I'm wondering, like, how do you balance becoming successful, becoming that standard without becoming the big bad ratings agency? The idea that, hey, you gotta pay up to Credora and get your vault rated or your yield rated, or else no one's ever going to deposit into it.
Katana is an opinionated blockchain. Its opinion is that for DeFi adoption, there are two key things we need: deep liquidity and high yield.
To learn more, go to katana.network. Hey folks, I want to tell you about our sponsor, Gearbox, the protocol that reimagines on-chain lending. With Gearbox, you can access 10x credit across DeFi or lend for passive yields with single asset deposits and no impermanent loss. Users can access leverage to margin trade, stake, farm, and more. To learn more about Gearbox, go to gearbox.fi.
$1 billion question, right? DeFi Dad. Let me try to tackle that one. So I do believe that with on-chain finance being way more modular than TradFi can ever be and higher transparency, there is more options to make it a viable business model without compromising on your integrity or trying to downgrade the reliability of your rating just to make someone happy, right? Since we've acquired Credora, we already saw people putting pressure on us to change some of the metrics or how we approach things, but we haven't updated any to make a single person happy. We did make some changes in general, if that was a valid feedback, because the model itself naturally can keep on improving. But here, I want to bring a podcast I recently listened to with CEO of Coinbase, Brian Armstrong from Davos, who shared a very interesting thought. At Coinbase, they right now implement disclosures and minimum listing standards against cybersecurity or regulatory risk in order to have an asset listing. But then they try to list a variety of assets and let customers decide which to allocate into, as Coinbase should not be the one recommending clients which one to choose. And here is a great example how probably modular finance is going to look like with Morpho, Euler, Aave going into V4 with hub and spoke model, where you have variety of choices for users to decide from. And then you need this party that is going to help to understand the risk in general. And a big opportunity here is with the two trends that everyone sees in 2026, which is institutions and stablecoins. With institutions going on-chain, recently we've seen the announcement of Bitwise launching their own vault on Morpho, which is like a very serious player. I can tell you with almost 100% confidence that this year we are going to see huge TradFi institutions launching their own vaults and on-chain strategies. And for them, the ratings are natural. It's not like a new concept. They would even expect it to have it somewhere in the on-chain environment. And we can showcase slowly that the TVL on rated vaults grow faster than on similar ones that are not rated. And even more important, the TVL is stickier, which shows that the users that look at rating are not the ones with mercenary capital going from one vault to the other whenever their airdrop is available, but it's rather more conscious user that is depositing somewhere for this 1 year APY or even longer. And as crypto goes mainstream, we are going to have more and more of such clients. So I do believe we are able, together with RedStone and Credora, find a model where we don't have to downgrade our standards in order to please anyone, rather keep a very high stance and follow, as you guys mentioned, L2B model, where initially people might even not necessarily like us, but the general public is going to recognize at one point that we are needed. With such situations as Stream Finance blow-up that happened in November 2025, where people thought that allocating into strategy that gives you double-digit yield without verifying is okay, when it turns out it's not, with almost $100 million hole in it. Credora at that time was not live yet, but we did some backtesting, and we should have given it a C rating, which is very low for the standards in DeFi at large. And here, maybe like last point on that front is usage of ratings is going to be way larger on the front ends with fintechs and neobanks expanding, because a neobank eventually would like to have yield sources listed for their users. And probably similar to Coinbase, they don't want to limit the users on what they are having to be displayed, rather give them some metric that will allow them to make conscious choices. And this is essentially what Credora is bringing. Vitalik shared this concept with a tweet of low-risk DeFi, and we try to help identify which strategies are low-risk. But the general concept that we are implementing and striving for is risk-aware DeFi, and this is the slogan of Credora at large.
Marcin, so many good points you made in there. On the L2B one, we were kind of discussing that offline, but I'm glad you brought it up again, because I see so many parallels between when L2B first emerged. They were kind of considered a bad guy by a lot of these L2 protocols because they were exposing everything to the public. And there was a ton of pushback early on against L2B, but L2B emerged as this, like, everybody's happy that L2B existed now. And I think even the L2s have a great relationship with them now. I think they kind of, again, raised the bar, brought them up to a better benchmark level of operating standards, essentially. Something else you mentioned in there, you talked about Bitwise launching that Morpho vault, huge. And this idea of institutions being already wired to accept risk ratings makes total sense to me. On that note, though, are you talking to any of these institutions already about your risk ratings and having any of those conversations behind the scenes?
I cannot disclose the specifics, but I can just tell you.
So that's a yes.
Yeah,
I'll take it. Great.
Yes, it is a yes. And look, that's true that they came to some of our partners and they asked, okay, where do we get risk rating? Without even knowing Credora, right? Because it's a natural flow of them. The risk rating industry in finance is over 100 years old. It's nothing new. It's nothing fancy. We are just trying to replicate what works well in TradFi and then implement it in DeFi and on-chain finance at large.
Guys, one thing we haven't been able to talk through is, where does the revenue that is generated through Credora, where does that end up? Is that in a Credora treasury that is separate from RedStone? Does it end up in a shared treasury there? Is there any chance that that revenue will be shared with Red token holders? I have to ask these questions. I'm a RedStone Red token holder, so very important.
Yeah, happy to take that one. As you know, it's been only a couple of months since we acquired Credora, and our first priority was to make sure it's back operational, which we did in November, and that the ratings work well on both Morpho and Spark, the two pioneers that decided to bring that standard with us to DeFi at large, and which we achieved right now. We have plans of implementing Credora into the broader strategy of Red tokenomics, but right now we are discussing it. To bring you some more context, before we decided to acquire Credora, we did a very comprehensive analysis of the market of rating platforms, because there are some. It's not that Credora is the only one, but Credora was absolutely the strongest. And there are two reasons for that. First, that many people omit, is that Credora rates three aspects: assets, markets, and vaults, whereas majority of the other players rate only assets. Similarly, the big rating agencies, S&P, for example, also engages in DeFi in general, but only on the assets level, usually even stable coins. And here, the depth is just deeper. And the second aspect is the possibility of making the engine as real-time as possible. So something that we touched upon in previously. Right now, we are introducing shorter and shorter intervals for specific metrics, so that when liquidity of a collateral asset moves, for example, 5% down, it can almost automatically and instantly influence the rating itself, because this is something that RedStone as an oracle aggregates data about all the time.
So guys, what are your longer term visions for Credora and risk ratings for 2026 and beyond with DeFi?
Yeah. So our objective right now is to rate everything. We want to continue growing and expand on ratings, starting to be that standard for investors. We are trying to effectively build an environment where good actors get stronger distribution, and bad actors are just motivated to improve, or just get completely cut out from the users. Because as the space progresses, the standards progress, and the standards are just higher, and people just don't tolerate these blowouts anymore. And we are effectively here to help.
Well, the universe is huge out there, and I do believe 2026 is the year that you're going to see simple on-chain strategies abstracted away for the users in fintech applications. Think Robinhood, Revolut offering those on-chain yields for their clients. And ask yourself, which ones they are going to plug into their platform? The ones that are rated or the ones that are not rated? And this is exactly the kind of peer pressure the industry participants, not only users, but also B2B actors, have to put in general to make those ratings spread like as a ripple. Talking about the future, we want to expand also into new types of markets that we rate. For example, we are evaluating right now perps markets, whether there can be a rating about the liquidity or the type of an asset that the perp market is created for. We're an active Oracle provider in HIP-free from Hyperliquid, where you can permissionlessly create new markets, and this is where ratings can come in handy. Or prediction markets, where sometimes you have markets that are for long period and repetitive. Let's call it US presidential elections. Or you have prediction markets that have low liquidity and are pretty opaque when it comes to resolution standards. An important aspect about Credora versus, for example, S&P or Moody's is that right now Credora has this RedStone lag. So we can potentially also create like a comprehensive platform that offers data and risk intelligence and create model where, based on updates of ratings or specific metrics like probability of significant loss, you can update on-chain parameters on lending markets such as Morpho Euler. So essentially what you're creating, you're uplifting the possibilities that DeFi gives you for the general structure with on-chain finance.
Yeah, we just had Veda on. We had the co-founder son from Veda, and they just announced that Kraken is now offering like an earn product where you can earn, I think it's yield with stable coins like USDC. I'm sure that they'll offer this with the likes of ETH and Bitcoin on chain eventually. But yes, this is one of the missing components. We were asking Sun all about like what do you do as a vault provider to ensure that basically there can be no room for error here, you know, when they are deploying those funds on behalf of Kraken exchange customers or users. they want to earn yield, but again, there can be no room for error. They cannot lose these funds. And Veda is a very advanced vault provider, and there's a lot of knowledge there that is ultimately productized through their vaults. But I know one of the parts of their methodology that will absolutely take advantage of Credora is just this. They need this. They need this sort of a product. I think it helps to create more transparency in terms of what yields you might be earning. I have no doubt that Kraken, I'm sure Robinhood will eventually have a product like this. We know that Coinbase has a USDC lending product through Stakehouse. It's just a matter of time. These mega players in the space, the Fintechs, they want to offer better opportunities curated on chain. And in order to do that, they need to make those opportunities more defensible. They need to be able to identify what are more defensible opportunities. And I have no doubt that a huge part of that will play into what you guys are doing here with Credora. Actually, any final thoughts you have on that? Like any speculation around like that DeFi-mullet product sector growing? Like I feel like, again, what you guys are building, what Veda's built, and a few other protocols out there, it is making it possible for the centralized exchange customer to finally get exposure to the best opportunities and yields on chain.
Well, I would love to continue that DeFi-mullet into B2B as well. So we're talking retail, right? But there are a ton of deals happening between banks. If you think about how can a fintech in Africa get financed today versus how they could get financed through DeFi, I mean, the possibilities are endless there. So having these frameworks to build financial products that bring more fair distribution of funds, I think it will be also a trend that maybe not for the next year, but after we hit the retail.
Very cool. Well, guys, I think this is a great place for us to start to wrap up. So I want to remind our listeners they can learn more about Credora by going to credora.network. They can learn more about RedStone, which is what Credora is ultimately falls under that umbrella. That's at redstone.finance. They can follow Credora on Twitter at Credora Network. Follow RedStone at redstone_DeFi. And then Marcin's handle is MARCIN Redstone. And then Gil's is GIL_N_Santos_. We'll put that all into the show notes so you can easily find it. Guys, thank you so much for joining us. I just want to give you the final word here before we go.
Look, maybe I'm going to end with some two strong statements. I believe that by end of 2026, stablecoins market cap is going to grow from $300 billion to over $1 trillion. And there are going to be two reasons for that. The first one is going to be payments, but the second one is going to be allocations into on-chain strategies into the ones like Veda, Morpho, Aave, and so on. And this is where Credora is going to play a tremendous role. And I can also tell you that I believe in 2 or 3 years, institutions going on-chain will use Credora as a requirement in order to allocate their capital into a specific strategy. And the reason I'm so confident about it is that we have a few years of experience already, and Credora team has an excellent track record and so far trust from market participants. So thank you very much for having us over here, and I'm looking forward to meeting you on the next one.
Thanks everyone for tuning in. To stay up to date with future episodes, plus get expert tips, strategies, and exclusive content, subscribe to our free newsletter at the-edge.xyz.